The UK stock market has returned on average 5% above inflation for the last 100 years. And over the last 123 years, if we took any 10-year period, the UK stock market has outperformed cash 91% of the time. But with inflation so high currently, and interest rates at their highest for 15 years, is it better to put your money into a high yield savings account? Throughout the last 15 years, we have seen the lowest interest rates in history, dropping as low as 0.1%. And we took advantage of that by buying homes and getting loans at these low rates. But in recent years, interest rates have been going up at their fastest since the 70s. And although we probably won't see interest rates as ridiculously high as they were in 1979, the current interest rate is 5.25% and is expected to go higher. If you're a homeowner, you're probably expecting to renew your mortgage at these new high rates. And if you're a renter, you've probably experienced a rent increase in the last 12 months. Although this sounds all bad, how do we take advantage of these high rates? Savings accounts have been notoriously bad for as long as I can remember, earning basically nothing even if you had thousands sat in them. And even today, when you can find easy access accounts with higher than 4% interest rates, a lot of people still have money sat in these low interest rate current accounts, earning literal pennies for their money. £270 billion is sitting in accounts paying no interest at all, which is what the banks want, as on average, they're paying 1.4% interest for an easy access saver. There is one simple thing you need to know about savings accounts. You should open up a savings ISA. An ISA is an individual savings account which gives you tax-free earnings, meaning that you can save up to £20,000 a year into the account, and any interest earned through that is tax-free. You don't have to worry about your tax rate or going over your personal savings allowance. You can find an account with the current best rate by using the online Best Buy savings tables provided by This Is Money. The link is in the description. Right now, you can find accounts that are paying up to 5%, and these are easy access or instant access, meaning that you can get into your account and take your money out whenever you want, or you may have to wait a day or two. I use an easy access saver with Chase Bank and with Monzo Bank, and they are paying 4.1% and 4% respectively. I use these as the apps are quite easy to use, and it only took me a few minutes to set up each account. If you were to invest £1,000 with an interest rate of 4%, each year you'd be paid £40. But if you stayed in your basic 0.1% account, that £1,000 would pay you £1 a year. And if you had more money, say £10,000, that 4% would pay you £400 a year, and the 0.1% would pay you just £10. That is a huge difference. The FTSE 100 has returned roughly 7% a year over the last 20 years. This includes the payment of dividends and the price of your shares increasing. But what does this mean? If you invested that same £1,000 into a FTSE 100 index, then you would receive £70 in gains that year. And that is split into £38.70 in dividends and £31.30 in price appreciation, based on the current dividend yield of the FTSE 100 index. This is clearly better than a savings account. You have the guaranteed income of the dividends and you have the possibility of price appreciation as well. But the stock market can go up as well as down in price. And right now, the FTSE 100 is not performing at its average level. It's slightly below. So why would you invest in the stock market when it's not performing well? To invest in the stock market is to play the long game. When investing in the stock market, you should be investing with no longer than a 5-year time horizon. The price fluctuations that occur on a daily, monthly, or even yearly basis can mean that your stock price can go from 20% up to 10% down, or vice versa, in a short period of time. And this is where the fear of the stock market for many Brits comes from. When looking at the returns over a longer period, the fluctuations flatten out. Stock market investing is long-term thinking, and that is why many don't succeed. You can start investing with just £1 using a company like FreeTrade. It's an app-based investment platform that is very easy to use, and it's FSCS protected, meaning that any money up to £85,000 is protected by the government. The key to mastering the stock market is diversification, and the best way to do that is to pick a broad market index fund or ETF. These are baskets of stocks that cover the whole market, like the UK or US, or the whole world. I covered how to invest for beginners in an earlier video up here. If the money you are saving is for the short term, like you're saving for a holiday or you're going to buy your first home, then a savings account is what's right for you. But if you have spare cash lying around and you don't know what to do with it, I would encourage you to invest in the stock market, although your capital will be at risk. Savings rates will probably continue to go up, and it is always good to keep an emergency fund on hand where you can easily access it. You should have this in an account which is making you the most possible money. So, move your money out of those low interest accounts.